Hi and welcome to iClub. My name's Terry Rogers. This month, guys, I'm in the hot seat. And on the other side, we're going to hear from three experts in their field. Andrew Morello, a favourite at the 2011 conference, is going to pop in and talk to us about the art of selling your home. Steve is going to jump in and talk to us about the merits of subdivision and property development. And first, Joe Terlato, partner and director at Acceptance Finance, is going to jump in the hot seat and talk about some of the areas of interest that the ATO are going to place on property investors this year. Joe, every year at tax time, the ATO brings out a hot list of industry and areas that they focus on. This year they've spoken about investment properties, people in real estate. Has this landed with you and the team at Acceptance Finance?
Yes, it has. Yes, it has, Terry. This year, that ATO has clearly defined that they are looking at investment loans.
Yep.
And also another factor they're looking at is this, the old split loan, which is a loan where people have all their money going into the one account, which is income from rental properties and their own salary. The tax office has clearly said that they're looking at that split loan facility again.
Why is there a focus on this, do you think?
The split loan, if I can just clarify exactly what it is. If we have an example of a client that has $500,000 worth of loans, and that loan might be your normal home loan, let's say $200,000.
Sure.
And then we take another loan of $150,000, which is your first investment property. You might have another investment property. Make it simple, another $150,000 loan, which is your $500,000 of loans.
Okay.
The old split loan facility is where it's all in one, all the income from those investment properties, all the salary, all the expenses, all your personal expenses and your investment property expenses are all in the one facility. So it's really just one loan of $500,000.
Why are people attracted to this type of loan?
It's sold on the basis that it does save you money, it saves you interest.
Okay.
It's a way of being able to pay your loan off a lot quicker. But which loan? This is where the tax office is saying, well, hang on, which loan are you going to be paying off quicker? How do we proportion the principal reductions in your home loan as opposed to the investment loan? Which investment loan? Is it investment loan 1 or investment loan 2? That's where the tax office is saying we can't clearly identify what's what here. So we need to clearly be able to mark the difference between your home loan, your investment loans.
As a property investor then, how do we administer this for tax time so we're ready?
It's a very simple process.
Okay.
You simply just have your loans split. You actually do go to the trouble right from the start, seeking the right advice, and make sure that your home loan is one loan. You pay $100, rule of thumb, it's roughly the cost of a split loan.
Okay.
And have a second account. If we go back to the example, $200,000 home loan, $150,000 investment loan 1, you pay $100, have a totally separate account number, totally separate bank statement for investment loan 1, and then we duplicate the same for investment loan 2.
Okay.
So we've actually got 3 bank statements, 3 different account numbers, and if I may keep going, the income that you receive on a personal basis, your salary and all your private expenses, go against your home loan.
The primary loan.
The primary loan.
Administer a little bit more at startup, I guess, as an investor.
Yes.
Take the time to establish 3 loans, spend a little bit of time to administer these 3 loans and set them up, maybe a little bit of extra money in order to save time and money and the focus of the ATO at tax time.
Oh, absolutely. To pay $200 to actually have the loan split into 3 and have it clearly defined which loan is tax deductible and then which expenses and which interest is attributed to the right investment property. So all your rental income from investment property 1 and the expenses all sit in that one account. You just simply hand over the statement to your accountant and your accountant will prepare your tax returns accordingly. To have your accountant have to clearly identify the first example where everything's going into the one loan, it'll cost you a lot more than $200.
And it'll also cost you more time.
Oh, an enormous amount more time to administer it and to be able to try and communicate what's what. And that's the issue. The tax office is saying, well, what is applicable for each particular loan? And to try and explain that is time consuming and it costs money.
For those who are in the position of having everything into that one loan at the moment, the advice you would give?
Have it reviewed. It's a very, very simple exercise. You may not even have to change institutions. Just simply have it reviewed and apply for what's called a variation to the loan. If you can clearly identify at this time of the year now, we're just in a new financial year, as soon as you finish your tax returns, apply to have the loans varied, if that's appropriate for you.
Using the case study that you've mentioned, we now have 3 loans, let's say, as an investor. One of our iClub members has asked us to ask you. There was the waiving of exit fees, I think in March this year.
23rd of March.
23rd of March.
Terry.
So exit fees have been waived, and that was the generic media release that we heard. Yes. What are the implications of this?
The implications are, and I'll clarify which loans, it might be easier if I go through which loans it doesn't apply to.
Okay. There shouldn't be many, should there?
There's a few. One of the most common loans in the marketplace is loans that are for investment properties. So the example that we were talking about before.
2 of the 3 loans would have been investment loans.
They are not governed or covered by this new legislation. So break costs or deferred establishment fees may still apply to that. They also will still apply to commercial loans on a commercial facility for a factory, investment properties, which might be an office. They are not covered by this new legislation. And in particular, fixed rate loans.
Okay.
So a lot of people have a combination of variable and fixed rate facilities. Fixed rate loans still will have break costs if the loan is terminated early, no question.
Okay.
So we need to just then clarify the type of loan that is covered by this.
Yes.
It's just your standard, if I may use your mum and dad type home loan with a variable rate of interest. Absolutely, there'll be no deferred establishment fees or break costs.
So if I'm a property investor, I have my home loan and I have the 2 other loans as per our case study earlier.
Which is our case, yes.
The 2 other loans will still incur exit fees.
Potentially.
Potentially. The 3rd loan would be void of exit fees so long as I had a variable interest rate.
Correct. However, this is where we come back to if the right advice was sought right from the start and we matched the right institution with what the requirements are of the client, you may not have any establishment fees or deferred break costs or any fees at the end of the contract on all the loans. It's just a matter of getting the right advice structurally at the start to make sure that you match the right product. There are some really good deals in the marketplace in relation to what the banks can offer. It's just a matter of trying to work your way through the maze and match the particular product with what the client's needs are.
For the one type of loan that the exit fees have now been waived for, will investors be hit somewhere else down the line with these savings?
We are dealing with the banks. So a bank will, if it's forced to defer some of its income, which it used to get at the end of a transaction.
And where they make most of their...
Absolutely. It's been quoted in the media numerous times. Banks make a lot of money from break costs, establishment fees, upfront and in arrears, which is the deferred establishment fee. They will make it up elsewhere. So they'll try and bring fees in at the start of a transaction. However, it's just a matter of seeking, again, the right product to suit what the client is after and capitalising on what the market has. It's quite aggressive at times. The marketplace does change and there are offers available where the banks try and buy more business. It's a matter of being able to understand what's available and have access to it.
A lot of information here. For our iClub members, how can they qualify what's being said here?
We seek a lot of our advice from our association, and the association receives a lot of its legal advice in relation to break costs, which we've just spoken about from Gaydon lawyers.
Okay.
And I'm happy to give that to you, Terry. Just
we'll make
pass
it
it on to your
available
members.
to the iClub members in the product library.
Absolutely.
Okay, so that'll be a document that pretty much reinforces everything that you've said today.
Correct. In much more detail.
Good.
And I've just summarised it.
How good is that? The carbon tax is a hot topic at the moment.
Yes.
and there's a lot of speculation as to the effect it will have. In your industry, is there any definite effect that you can see it having?
No, how long's a piece of string?
Okay.
I don't know what the impact will be. However, again, if there are costs which are passed on or incurred by institutions, the end consumer, you and I, will always end up paying for it.
Is it a good opportunity to take up some sort of insurance? Because of the speculative nature of what may or may not happen and the impact it may or may not have, is it something that people can consider?
You could consider a lot of things in relation to the carbon tax, and it's a really good point, Terry. It's something that's very topical, but it's so new. It hasn't even hit the marketplace. We probably won't even know the implications, if there are any implications, for the next year or two.
So don't act with haste now.
Absolutely not. It's not something that you'd want to have a knee-jerk reaction to. Let the politicians sort it all out, see what happens in the marketplace. If there's any impact, we will know, and then we'll try and work our way around that.
That's a pretty simple question that I've asked you about it. Sometimes we're too intimidated, shall we say, to ask our finance team these questions.
Yes.
There's this used car salesman sort of inner sanctum where you don't want to reveal those secrets, and perhaps we feel like we can't ask these questions. What do you say to people who perhaps have that relationship with their finance team?
I would simply put it down to, if that's the type of relationship you have, it's probably best to seek another type of relationship. You should be able to ask any question about any part of the transaction at any time, and have those advisors around you that you're comfortable in asking that type of question.
Am I going to be charged every time I call you up, Joe, and need 10, 15 minutes of your time?
Absolutely not. You shouldn't be paying a fee to seek advice in relation to a mortgage from anybody.
How do you at Acceptance Finance, the team, what are some of the mechanisms you have in place to make sure that your people feel like they can communicate with you? Do you have a newsletter? Do you have, how do you reach out and touch your people to keep them educated?
There are constant articles that we produce, that we put in our newsletter, and I'm happy to give you access to the newsletter.
Great.
It's all educational. It's just at that particular point in time, there may be some queries that are put to us by the clients, and we'll try and answer them in that newsletter.
Well, Joe, thanks for your time today. Thanks for clarifying some of those issues around exit fees, talking to us about how we can be structuring ourselves around tax time if we have that big loan.
Yeah.
And also making available the letter from Gaydon's lawyers and your newsletter as well.
Oh, absolute pleasure, Terry. If we can be of any assistance, any clients have any questions about anything, absolutely pass them on to us.
Beautiful.
Happy to answer them.
Thanks, Joe.
Thanks for your time.
Thanks for that, Joe. As always, it's great to hear from any member at the team at Acceptance Finance. Guys, be sure to jump into the product library where you can have a look at the case study that talks about separating deductible and non-deductible debt. The team at Acceptance have also got their latest newsletter and also a document from Gaydon Lawyers regarding exit fees. Steve was the next cab off the rank, sharing his thoughts on subdivisions and renovations, and even offering more insight into the pending carbon tax. Steve, why do you think subdivisions and property development have become even more popular as forms of capital appreciation rather than the good old reno?
When it comes to capital appreciation, there's two forms. There's what I call generic capital appreciation, which is simply gains made by the market going up.
Yep.
Not really in control of them per se, it's just the market's going up in value and you jump on board and you make some money as well. The second type of capital appreciation is what I call manufactured capital appreciation. It's where the investor uses his or her skill and time and money and ability to be able to unearth an inefficiency and to turn that inefficiency into an efficiency and then to sell it or refinance it and make a profit. For example, you've used the renovation situation where an inefficient property in the form of a dwelling that is either a little house on a big block of land or alternatively a house that is past its best as far as appeal goes is morphed by adding more perceived value than actual cost with the investor's skill to manufacture a profit. So why are these manufactured type profit outcomes becoming more appealing? And I think the answer is because people are becoming more sophisticated. Once upon a time, the idea of doing subdivisions and developments was for property developers, for the Henleys of the world, the Metricons and that kind of thing. But now, as people have got access to more information and also potentially new finance products that have come on board over the last 10 years, they feel empowered not only to be able to do it, but to be able to finance to do it. So the profits that once upon a time were seen as not achievable are now seen as achievable because people feel empowered.
Do you think that mum and dad renovator are biting off more than they can chew sometimes by becoming a property developer, subdivisions and such?
Well, I think everyone wants to try and be better than they are. And there's a world of difference between thinking you can do it and being able to do it successfully through to the profit stage. And often when it comes to investing, we buy on the best case scenario, and it's a pity if we have to then sell on the worst case scenario. Do mum and dad type investors think they can do it? I would say yes. And why? Because we've got Bunnings that puts ads on TV about being able to do home renos. We've got shows like The Block and Renovators or whatever it is on TV that populate the myth that anyone can do it. Unfortunately, not anyone can do it. And when it comes to renovations, in particular, it's better if other people do it and the investor manages them than the labour savings that come by the investor doing the work to try and make a profit at the back end.
This is a bit speculative, but there's a pending carbon tax. What will the ripple effect of that be to renovators and property developers?
Can we talk about the carbon tax to start off with? I know you've...
Like this much time.
you have worded it so apolitically that you've sidestepped that issue very well. But I think it's important that we just spend a tiny second looking at it.
Sure.
And I make no points about necessarily it's good or bad. The idea behind this tax, which is different to other taxes, is that this isn't a tax on profit. This is a tax to change behaviour. So you've got choices when it comes to changing behaviour, a stick and a carrot. And so what they're trying to do is a bit of both.
Yes.
They're trying to use a stick against business in the form of a tax to encourage them to emit less carbon dioxide, and they're trying to use a carrot in some ways to entice people to make a saving of their emission, and because they're going to be compensated, if they can reduce their emission by saving money, then they will be better off because they'll be compensated at this level for this level, but if their emissions go to this level, then this difference will effectively be money in their pocket. I don't know that you change behaviour by doing that. And the proof of the pudding will be in the eating. I have a general misgiving that is the best way to approach it. Because what you're saying is that people on lower incomes use less energy or more energy than people on higher incomes, because you're not compensating the higher income earners, but you are the lower income earners. So when you look at like a pyramid or a distribution of population, there are always more people in the lower and the middle than there are the upper. That's just the way that the numbers fall down. So with this particular carbon tax and this particular model, if you are compensating the lower, to a certain extent the middle and not the upper, then it's not going to deliver, in my opinion, the behavioural change needed. So therefore, let's talk about the cost of doing it, because the cost of doing it, therefore, is it's going to make properties more expensive. The HIA has estimated $5,000 per new dwelling. I'm not sure what that's based on, but $5,000 is the figure. You will not be compensated based on the government's plan at the time of this recording for that $5,000. It will simply be money out of your pocket. What will that do to the property market? Well, if real estate becomes more expensive, Economics 101 says people will choose to rent rather than own. When you take away the demand out of the market, the supply stays the same, price must fall. So in regards to the carbon tax and its effect on the property market, everything else being equal, people will not be compensated for the extra cost, and so demand will be impacted negatively. Supply, we don't know yet, but when demand shifts and supply stays the same, price must fall on a downward scale.
This, again, we don't have a definitive answer to, but we're told that there will be green energy solutions for us, both residentially and also on a larger scale. Do you think that property developers, renovators will make this shift to incorporate green solutions into their new homes?
Only if they're compensated by the government for doing so. One of the principles of renovating and indeed developing is that you have to add more perceived value than actual cost. These new technologies that make houses green are more cost than perceived value at the moment. The end customer is more interested about an affordable house than a super green 6-star energy efficient house. And so developers will build what the client demands. And if the client demands less efficient, affordable homes, then that's what developers will supply. So the only way to get around that is if the government comes on board and says, you know what, we're going to provide money for you to incur that extra cost so your profit margin isn't shrunk or trimmed. We have to wait and see whether the government will do that. There's no plans for it at the moment. We have seen schemes such as solar rebates and insulation. So pushing the actual validity of those programs to one side, we've seen the government is willing to try and provide green solutions, but there's a ways to go for mum and dad renovators and also developers before it becomes mainstream, in my opinion.
Talking at the working stages of being a developer, how, and this is probably reflective of having read some of your nationally recognised training, the new product that we have at propertyinvesting.com, how critical is the pre-development stages of these projects? Planning application, council inquiries. How important is it to be on the button when doing this?
Well, buying a piece of real estate as an investment is a lot like getting married. Once you say I do, it's not easy to get out. Yes, you can get divorced, but it comes at a cost. So when it comes to a subdivision or a development, if you buy with the hope of making money or the expectation of making money but haven't done your due diligence associated with determining where the issues may be and you hope, then you're always running the risk of losing money. So how important is the pre-work? Well, it's more important because, as I often say, the more things you leave to chance, the more chance there is that things will go wrong. So the speculative-based investor will buy and hope. The diligent or the outcome-driven investor will take that risk lower by investing the time up front. At our conference, Terry, you may remember me talking about John West investing.
Yeah.
And the notion of John West investing is rejecting the deals that others accept. And I think that's what we're talking about here. I would encourage the people watching this video to be known by the deals they don't do as much as the deals they do. And the deals that they don't do need to be rejected on the basis of being marginal rather than hoping that everything's going to be working out.
You touched on time. Do you think a lot of investors underestimate the time factor involved in doing a development and a subdivision? And if they do, how much that can hurt them financially?
Well, it's been said time is money, and in my own experience when it comes to developing, I would totally agree. Coming back to a point, when we invest, we often expect the best case scenario to unfold. The reality is that the best case scenario is about as likely as the worst case scenario. They're both possibilities, but in reality, somewhere in the middle where it's going to be. So when you budget your time for a subdivision or a development or a renovation, as you should, even a buy and hold, how long do you hope to hold it for? You need to have contingencies on the basis of what happens if there is a budget blowout on the time, because ultimately you will be having finance if you're borrowing against it, and the longer the project takes, the more interest that you'll pay if there's a blowout. The more interest that you pay, the lower your profit margin will be.
Steve, speaking of budgets, we all want to deliver on time and under money. Talk to us about the merits, in your opinion, of enlisting an architect, a designer in these early stages. It may cost a bit more from the outset. What are the merits of doing this and making sure that they have a good relationship with council as well? How much benefit will that bring?
You're talking about leverage, Terry, and most people will know about the concept of leveraging money. You borrow from the bank 80% and you only have to chip in 20% of your own money, so you can do more with your limited capital. Well, why can't you apply this concept of leverage to skill too? Well, you can. So you have your certain skills and they will allow you to do certain things. If you want to do more complex projects that are outside your skill, you can either hope, which is dangerous and adds to risk, or you can involve other people who do have that skill that you need and pay the price accordingly for it. The danger, I believe, or the biggest danger, is when you want to involve other people but you don't have enough money to do it, so you just effectively invest blindly in the hope that it's going to work out. I would say to the people watching this, if you don't have the money to invest in good advice up front, then you don't have the money to invest, full stop.
People need to not only factor the finances for the investment, but also with the skill set that you may need to pay for to supplement that investment.
And indeed, you don't need to know everything yourself, but you need to know people who know the things that you don't, because if you don't know what you don't know, often those things can end up tripping you up. And sitting with someone and getting an hour's advice, or alternatively showing some diagrams and, can you look over this, in my opinion, is money well spent.
In propertyinvesting.com's latest product that you have spent years developing, our nationally recognised training course, you speak of the 6 Ps involved in property developing: product, potential target market, price, position, presentation and promotion. Without being able to rattle off on all of those now, these 6 principles, how important are they in your opinion?
They're essential, and credit where credit's due. Those principles were taken off what I learnt from discussions with a very successful property developer that I know called Martin Isles, and Marty based in South Australia. So a couple of years ago, Marty did a seminar, and in my revised first book, he was kind enough to work with me on providing some information that got panel beated into those 6 Ps of property developing. What I think is very dangerous when it comes to developing is the field of dreams type expectation: build it and they will come. What I prefer investors to do is to do the research into their target market and to look at what people want in terms of the product, the price, the potential target market, who's going to buy it, and then build not what you want to build, but what people want to buy. And that's a big distinction, because when you get architects involved, often they will have a creative edge, which is their flair or something else they want to put into the building. But as investors, we shouldn't be too worried about that. Leave that for the domain of the homeowner. As investors, we want to build, as property developers, houses that people are willing to buy. So we need to know what product they want to buy in terms of housing product, what it includes, and what price.
Thanks, Steve, for sharing your thoughts on how to best increase our investing capital through renos and subdivisions. Now, finally this month, the enigmatic Andrew Morello made himself available to deliver education on the benefits of selling at auction and much, much more. Morello, thanks for your time today.
My pleasure, Terry. Glad to be here.
We're standing up. We're not sitting down for this interview. You do some of your best work standing up.
Always, Terry.
Good.
It's where I can get the energy out and the juices flowing.
Good. Today we've actually just had Steve in the hot seat where you are, and he was talking to us about subdivision, property development, talking about how that's a growing trend opposed to just a good old renovation for property developers.
Yep.
Do you agree with that sentiment?
Look, I certainly do, in a sense that, Steve's a guru, and certainly the trend in the market is people are starting to take a little bit more risk again. But if you're in a financial position to be able to take the next level, there's a couple of things you should be doing. Is one, either purchasing a property on a large block of land. I've got a client right now who's just purchased in West Meadows, in Melbourne, sort of in northwestern suburbs. Probably not ever been seen as an ideal suburb for development, but the idea behind it is to land bank the property for 2 to 3 years, take the yield off it, which is very reasonable, and the rental return, and then basically from there work towards getting plans and permits for 3 townhouses and going to build those later on.
More risk involved when you try to manipulate the capital that you want to yield through subdivision and development, isn't there though?
Very much so. People are going around looking for those slightly larger blocks, looking to put 3 townhouses on them, but you really need to be cashed up right now. I'm not here to scaremonger, but people really underestimate holding costs. And holding costs seem to be what's causing the mum and dad investor to either have to force sale or urgently sell or sacrifice the potential they could make on a property.
There's a lot of speculation, there's a lot of uncertainty, there's a lot of change in the economic climate.
Yep.
What are you seeing in real estate? Because you still actively list and sell in the family business along with your involvement at Yellow Brick Road.
Yes.
What's your feeling of the real estate market?
So I'm very lucky to be involved in 70 Yellow Brick Road branches nationally, so I get to hear the sentiment that comes back from them. And funnily enough, I'm certainly not here to get political, but funnily enough, I think the reason why Australians have sort of taken really their foot off the brake recently, their foot off the accelerator recently, and really slammed the brakes on pretty hard, is a couple of things. You mentioned the word uncertainty, and I think uncertainty right now in the market is absolutely ripe due to a couple of reasons. Now, when John Howard was going to introduce the GST, we all, there was a lot of scaremongering, and we all thought it was going to change the the way that we lived our lives. And then once, the GST came to effect, we realised it was just the new way of life. It's the same with the carbon tax. Now, whether you're for it or against it, I'm not here to discuss that. What I'm here to discuss is if the political environment was a place where they said, well, this is what's happening and this is how you need to deal with it, then of course, then essentially you become more comfortable with with making decisions around property, around property investment, around hedge funds, around financial planning, and so you become a little bit more comfortable because you go, well, that's the economic climate. I know what I'm dealing with. I can start to make decisions. Because with the recent government, there's been a lot of uncertainty, and that's not a political view. That's a fact that there hasn't been that definition of what's actually going to be happening. It's caused a bit of a ripple effect.
One of the reasons that we've actually got you in today is obviously your real estate background and your auctioneering background.
Yeah.
And I think something you're still very, very passionate about. Before, when you were sort of out the back, I heard you say that you've got 6 or 7 auctions this weekend.
Yeah.
I'm really jaded.
Yeah.
I pick up the paper on a Monday.
Yep.
Auctions clearance rates nationally are down.
Yep.
On a Monday. And then on Tuesday, I read an article about real estate agents not giving true account of their clearance rates, true account of what's being passed in and what's not.
Yep.
How is investor sentiment meant to be favourable to this?
Yeah. Transparency has always been an issue with the real estate market, so it's always a difficult thing. The clearance rates should incumbent, so this is an education for people that are looking at these sort of figures, should incumbent things like if properties are passed in and sold immediately after, which is often what's happening now.
Yeah.
So to give you an idea, last week we had 6 auctions, passed in 5 out of 6, sold 4 of the passed in immediately after. So a lot of agents, and at times a lot of agents will report that as sold at auction, because effectively those figures are taken from sometimes the agent who's selling it, sometimes the receptionist. So what happens is your realestate.com, your domain, they jump on the phone, they call in the receptionist to ask them the results, or the receptionist will email it through. Because it's sometimes third-party perspective, you don't really get an opportunity to get the true value. One thing you should be wary of is agents sort of making up offers, which has started to creep back into the market, especially in Melbourne. It's been going on in Sydney for a while, I can tell you that, because of the difficulty in the market. And what it is, and this is where the problem stands, that right across Australia, a real estate agent who's selling a property tomorrow at auction actually appraised that property 6 to 12 months ago. That's the problem. So you appraise a property 6 months ago in Melbourne, it's a different price than it is today. And so you appraise a property for Mr. and Mrs. Terry, and Mr. and Mrs. Terry decide that they want $1 million for their home. Or they want, let's say, $500,000 for their home. Then what happens is they call you, they paint the walls, they paint the white picket fence at the front, they get the roof fixed, they patch up those holes that the kids kicked in their bedrooms, and then by the time they're ready to sell, they come back to you and they still want their $500,000. All of a sudden the property's worth probably somewhere between $450 and $500 now. And so essentially what's happened is that there's a period of time and a lag period when the market starts to slow down a little bit, where vendors need to get used to the new market, which is, I think, started to happen. I'll talk East Coast here because I know it's really well. It's certainly started to happen in Queensland, starting to happen in Sydney in certain areas. And then Melbourne, we're usually the last to sort of slow down, but we're always the first to kick off. It's a very stable market. Sure. And so, and there's a lot of interest from interstate investors too. So I think the fact of the matter is, with regard to an auction, a couple of things you should be wary of in this market is, one, agents saying, look, passed in at say $450, later off for $485, vendor reserve $495, when they probably, I'd like to question that $485 with some of the agents and certainly some of my competitors. But the fact of the matter is that usually the reason why the agent's doing that is vendors are pretty far away still.
Murillo, you spoke just a minute ago about the different types of data that are available to people with regards to auction clearance rates and the like. Where do you go to to get your data?
Pricefinder.com. So at pricefinder.com, you should be able to access a free property report on the back of it. So I know RP Data are charging for it now. So I believe they do, and they pull the same data as RP Data. Now, something that allows you to do is, if you're educated in the market that you're looking at with Pricefinder, it's got little price indicators. So for example, when it pulls up the 5 most recent sales in that street or similar properties, and you've put in the criteria, and when it produces the report, report, before it produces the final PDF, what it actually does is it brings up the properties. Now, if you know those properties, if you're an active buyer and you've actually been looking through and you go, well, I went through that one and not that one, and that was an exceptional price for that because there was 3 bidders there, or that one there, certainly isn't as big a land or isn't as well renovated and so forth. There's actually a little slide indicator at the bottom of the property that you can actually move as more positive or negative. So it actually gives you a more true representation of where the value of the property should be.
All right, good. What are the benefits of going to auction right now in this climate, 2011?
Certainly right now in this market, look, an auction market is always, because in a sense that it's an educational process for the buyer and it also brings it to a head, right? But right now, a lot of people are trying to go for more the private sale way. The problem with the private sale is it certainly does cap the prices. And what we found post GFC, everybody decided, oh yeah, I want to start doing private sale again. They didn't want to do auctions anymore. And then what happened was the market caught up very, very quickly. And there was probably a 3-month period, nearly pretty much right across Australia, where the market was actually doing a little bit better than what people expected it to be, because everyone was still in shock and awe from the GFC. So, the positives and negatives of a private sale is one that, you can sort of say, well, that's my price, you know what you get to work towards. And if you're a purchaser, sort of know, well, that's the vendor, that's what the vendor's prepared to pay. The problem is often people won't make that offer. They're not prepared to pay full price. Everyone wants to feel like it's a win-win outcome and as if they've got a deal. The problem is now, with the new legislation, if an agent puts that as the asking price, he can't actually have any flexibility there. So it used to be once upon a time, you wanted $1 million, the agent would put $1.50, or you wanted 500,000, he'd put 520. So you would come in and make an offer of 480, and then you'd find the happy medium and be 500. Now,
no latitude for that.
There's no latitude for that. So now with the new legislation, usually the agent is actually putting the vendor's final price on as the asking price.
Yet the consumer is still going in with his old mentality.
Correct. So thinking, well, okay, it must be overpriced. The vendor wants more, so I'll make an offer here, and so forth. But the fact of the matter is, right now on a private sale, nearly right across Australia, it's about on par of what actually the market value is. And the conversation real estate agents are having with their vendors at the listing stage is, Mr. and Mrs. Vendor, first of all, what's your motivation? So when I do my real estate training, one of the first questions I get people to ask their current potential vendors right now is, what's your motivation? If there isn't a motivation there and they're checking the market, I recommend to agents, don't take the property, because I say you're going to be sitting around like Toop and Toop, which is a very prominent agent in Adelaide and very well known and very successful. They've currently got 500 properties on the market, which is the most they've ever had. So they've got a lot of what we call in the industry dead stock sitting around. So certainly a buyer's market in Adelaide and certainly in parts around the country. And the fact of the matter is that it's dead stock, but the vendors are sort of sticking to their guns. They're sort of saying, well, this is what it is. With an auction right now, there's certainly an opportunity for a buyer to purchase a good buy. And vendors that are going to auction are saying, well, usually they've bought somewhere else, they're prepared to come to them, prepared to meet the market. And the worst thing that a buyer can do in this market is not bid at an auction. So what's been happening is we go out to auction, we call it out for the first opening bid. What's usually happening is everyone's putting their hands in their pocket. Then as soon as we pass it in, 2 or 3 people are coming up and trying to make offers. Now the vendors are in selling mode at that point. So a vendor says to us on auction day, we want to sell, and often a qualifying question I'll ask them before I walk out and auction off their home, whichever state I'm calling the auction, I'll walk out and say, Mr. and Mrs. Vendor, just to confirm, you do want to sell the property today. And they look at you as if it's a bit of a dumb question, but it's a qualifying question. It's a mindset question. Now, Mr. and Mrs. Vendor, you've come to this. It's been 4 to 6 week campaign. You've had, 30 groups through the campaign. You've had a couple of offers prior to auction. Today's the day. If you're going to get your money, today's the day. And usually what happens is that if the agent's done their job correctly, they've educated the vendor, they've educated the buyer, and they've told them where they need to be on the day. So if you're a buyer, put your hand up. Vendors aren't there to sell right now.
Think about this. I'm going to auction, my house is for sale, I've got 3 months before we go to auction. I want to increase the value of my home and I want to spend as least as possible in doing so. What do you know is going to catch the eye of a potential buyer and I can do around my place to give me maximum return?
Yeah, so I'm a big believer, and this is always different for every agent or every property professional, and it's always different for every area that you speak to. But I'm a true believer, as if you try too hard, people will see that. So, for example, if it's too perfect and it's not a professional job, people sort of say, well, what are they trying to cover up? Sometimes I believe wearing your heart on your sleeve, having a few blemishes isn't the worst thing. But, you know, the basic neutralising, you know, I've worked in a lot of period homes. And, you know, a lot of the Federation colours or the period colours are like your pinks. And there's period homes all around Australia. And, you know, even I was in Queensland yesterday, the Queenslander homes. A lot of them are your pinks and your yellows and your oranges, so fairly bright colours. Now, of course, that's not going to be everybody's taste. So the fact of the matter is you really can't go wrong by just neutralising the colours right throughout the property, right? Whether it's internal or external. I don't think you can really go wrong by doing that. Second point of call is just really either get some storage or literally get a skip and just get as much out of the property as possible. At the end of the day, even if it's a large home, the fact of the matter is that you need to depersonalise and produce a blank canvas. My opinion is, first of all, would be neutralise the colour scheme. It's very, very easy to do and can be very cost effective. If you're time poor, then of course employ someone to do it. If you're not time poor then and you want to save a bit of money, then pull out the paintbrush and give it a go yourself. I always reckon maybe get a professional to do the hard things like architraves and things like that. You know, maybe get most of it done, get a quote. Look, just be creative at the end of the day, but just try and keep it very, very simple.
2 points you've made.
Yep.
Neutralise.
Yep.
Create space.
Yep.
Sorry, and a third point, and depersonalise. In closing,
Yep.
there's a bit of upshot in this particular climate. We've spoken of uncertainty, we've spoken of change. There's still opportunity.
Yeah.
Reinforce that to us where you believe it is.
Okay, so Terry, I want to link this to the previous question you just said, because right now, I believe cash is king, right? And what people don't realise, a lot of them have cash sitting in their current and existing home. So, you know, the first point of call is, you know, speak to, you know, either your mortgage broker, your bank or whoever, or your financial advisor, and seeing what sort of position you're in from an equity point of view. Now, some of the things you can do before getting your property valued by your bank or your financial institution is something as simple as this. Is of course subject to council approval, but things like building, spending $2,000-3,000 on building some sort of undercover car accommodation at your rental property or your own home, if you don't already have car accommodation. Now you can build a sort of a carport for the sake of about $2,000-3,000, something that looks very, very reasonable, and that can be done professionally, and that will automatically add somewhere, in my opinion, between, you know, approximately across the board between $15,000 and $50,000, depending on if you're in a city or in the suburbs. Now, what I recommend is things like that. Giving the place a bit of a paint, giving it a bit of a clean up, just being vigilant of all these things. And then if you can do that, get in the existing portfolio that you own, whether it's your own home, that's all you own, and you're looking to buy your first investment home, or it's investment properties, get it all revalued by the bank and actually get a bit of a position where you might be able to say, well, look, we've got $150,000 there. Why don't we pull 75 out and go put a deposit on, you know, a little one better or something a little bit further out in the suburbs that we didn't traditionally look at, but it sits on a big block, and if we hot land bank it for 2-3 years, then there's going to be certainly some opportunities. The last point of call I just want to say is right now, auctions are gold. You know, the fact of the matter is vendors are there to sell. So if you are in a position where you've got a little bit of money, have the checkbook in the back pocket or a blank check and just have it in the back pocket, and just, you know, the fact of the matter is right now, cash is king. If you're prepared to make an offer on the day when the vendors are there to sell, there's some real opportunity, and you know what? It's a happy win for everybody.
Morello, thanks for your time today.
My pleasure.
Always good having you. We'll have you again soon.
My pleasure. Thanks, Terry.
Folks, there is another EPAC. I'm exhausted. I'm sure you're exhausted from hearing all that. You'll need to listen to that again in slow motion. Be sure to jump into the product library to get the documents that the team at Acceptance Finance have made available to you. Make yourself a cup of tea, and we'll see you next month.